Hey, we're back again with really hard accounting. Today we're talking about accounting for impairments. So hang on to your hat and here we go. In this module, we're going to evaluate assets for potential impairment. Parent Corporation acquired 100% of the outstanding shares of ECO last year. And ECO itself has separate operating divisions, which we call Cash Generating Unit Number 1 and Cash Generating Unit Number 2. I appreciate there's a slight lack of imagination in those names. Let's keep in mind that ECO keeps a separate set of books as it is a separate legal entity and for each of the divisions. In addition, we can't lose sight of the additional consolidation adjustments to reflect the purchase price of the ECO acquisition. Impairment analysis is required at least annually or as indicators of impairment arise. There are many indicators of impairment to consider, and professional judgment is required. Some examples of indicators would include loss of a major customer, a large unexpected loss, or perhaps the emergence of a significant contingent liability. A cash-generating unit is the lowest level of separately distinguishable assets and cash flows. This may be a division, a region, or even as low as a single location, as in a store for a retail chain. So the first important impairment concept is to define the cash-generating units within the legal entity. The analysis presented here has allocated the purchase price paid by Parent Corporation to both cash-generating units. The analysis would work similarly at the ECO legal entity level, only book values would be allocated to each of the cash-generating units rather than the purchase price allocation. Let's walk through the schedule to understand the information. The purchase price line on the schedule estimates the value of each cash-generating unit by looking at the future cash flow expectations of each of the cash-generating units. This sort of analysis requires financial analysis and a business plan to prepare. The total value equals the price paid by Parent Corporation, at least initially. The second step is to allocate the total unit value to separate assets and liabilities on the basis of their individual fair values. At the date of acquisition, we need not worry about impairment as the price paid is the fair value. Now, let's turn the calendar 1 year for each of the cash-generating units. The only transaction arising during the year were the amortization of depreciable assets over their estimated 10-year economic life and the 1/10 repayment of long-term debt. All other balances remain the same. Note that the balance includes the acquisition adjustments for consolidation purposes. We can tell by the value attributed to the intangible asset and the goodwill. There are assets that are not recorded on the legal entity books of ECO. The finance group prepares an analysis to value ECO. Valuation techniques such as a discounted cash flow analysis are commonly used to establish a proxy for what the company is worth. In this case, the analysis suggests that the equity of ECO has declined from the $1,040,000 at the date of acquisition to $820,000. In the same way we had to allocate the purchase price upon acquisition, we would use a similar methodology to allocate this value across all the assets and liabilities of ECO, which has been done for us in the first column. The second column picks up the total book value of our net assets. The delta indicates which assets have appreciated in value and which have declined relative to book value. However, impairment is not calculated at a legal entity level when there is more than one cash-generating unit. We must now split the valuation between each of our two cash-generating units. This table drills into the details of our legal entity values and splits both the fair value and book values of our assets and liabilities between each cash-generating unit. Cash-generating unit number 1 has equity value of $500,000, and cash-generating unit number 2 has equity value of $320,000. These values have been allocated to the respective assets and liabilities on the basis of fair value. In the case of cash-generating unit number 1, we see that goodwill has appreciated by a modest $10. GAAP does not permit us to write up our assets to account for the value creation after the initial acquisition. Otherwise, all the other balances in cash generating unit number 1 are the same. Thus, we have no impairment issues in cash generating unit number 1. Cash generating unit number 2 is a different story. Remember that at acquisition, this unit had a value of $520,000. Some of that value has eroded due to the aging of the property and equipment, but there appears to be further declines in the value over and above that for the property equipment of $148,000 and for the goodwill of $21,000. The patents appear to have appreciated in value by $10 and thus are not impaired. However, with the decline in value of both the property and equipment and the goodwill, we have an impairment charge to take. Our impairment charge for the current year will amount to $169,000, and it specifically pertains to cash generating unit number 2. The property and equipment and goodwill will be written down to their fair values of $498,000 and $31,000 respectively at the reporting date. Let's now roll forward the calendar another year, and this time the economy is stabilized and the valuation is the same as it was 12 months previously. Once again, our consolidated book values are presented here. The only transactions occurring during the year were to record depreciation and repay debt. The unadjusted book values of the property and equipment of $310,000 and goodwill of $10,000 reflect the impairment charge taken in the previous years. Let's reanalyze impairment. Using our valuation techniques, such as a discounted cash flow analysis, we determined that the equity of ECO has remained stable at $862,000 at the end of year 2. Once again, the analysis will allocate this value to each of the assets and liabilities of ECO to simulate a purchase price allocation as shown in the first column. The delta column indicates the potential for some appreciation in the fair values of certain assets. Next, we split the assets and liabilities between the cash generating units. This table summarizes that split of asset and liability values between the two cash generating units. As our overall valuation has not changed between year 1 and year 2, the appreciation in value is largely attributed to the fact that while we have depreciated our assets for another year, the value of those assets remains the same as it was at the beginning of the year. Let's review each of the cash generating units to see if there's any impairments to consider. For cash generating unit number 1, both the property and the equipment and goodwill have positively appreciated. GAAP does not permit the appreciation to be recognized subsequent to the acquisition. We have no impairment issues. For cash generating unit number 2, property and equipment, intangibles, and goodwill have all appreciated. We can conclude that there's no further impairment charge necessary in year 2. However, there is the possibility for an impairment reversal on the assets that we previously impaired in year 1. An impairment reversal is permitted for assets that were previously impaired, those being property and equipment, where the indications of the impairment have reversed or lessened since the last assessment. Increases in the recoverable amount from the passage of time do not count. Goodwill impairments are never reversed, and any subsequent increase in the value of goodwill is assumed to be as a result of internally generated goodwill, which as we know is never recorded on the balance sheet. Once again, we calculate a recoverable amount using the procedures we discussed already and allocate the values to the various classes of assets. The impairment reversal is limited to the lesser of the amount of the impairment charge previously taken, the amount that writes up the assets to no more than it would have otherwise been recorded had normal depreciation been taken all along. The application of an impairment reversal requires us to track multiple continuity schedules. One continuity schedule will track the net book value including the impairment charges previously taken. The other will use the original values allocated to these assets. The impairment reversal is permitted for a previous impairment charge, but only to the extent that the book value restored is not greater than it would have been otherwise had no impairment charge occurred in the first place. In this case, Had we continued depreciating our planned equipment at $55,000 per year, our net book value at the end of year 2 would have been $443,000. This is our ceiling for an impairment reversal. However, the valuation suggested only a partial recovery of the previous impairment. Thus, in this instance, we are able to record the full amount of value recovery in the current period. So to summarize this very complex accounting topic, impairment analysis under international standards follows a one-step model. It requires a comparison of the recoverable amount to the carrying value to determine whether an impairment charge has occurred. This analysis is updated annually or as indicators of impairment arise. Subsequent impairment reversals are possible where there has been a recovery in value. However, recoveries are limited to what would otherwise have been the net book value using historical cost principles. Obviously, this gets a little more complicated if the company is using the revaluation method for its capital assets. But fortunately, few companies do. And thus I feel justified in leaving aside this complexity for the purposes of this course. That's all for now, so until next time, don't stop till you get to the top, and you get to the top, don't stop.